Welcome everyone to the MFS-Wharton Virtual Summer School, first ever virtual or any summer school from the Macrofinance Society. Just to give people some background, Macrofinance Society has been active in promoting research in macro and finance and intersection of macro and finance, and with a particular focus on helping young scholars make their way in their careers in this field. And of course, one of the goals of the society, therefore, is to promote the new ideas as well as methods of macrofinance research to hopefully wider audiences. And over the last 5 years, we have been hosting lectures and methods and advances in macrofinance as part of our meetings that the MFS holds in the fall and in the spring of each year. And we've been able to do this with the generous support of the Sloan Foundation. Unfortunately, of course, due to the pandemic, we had to cancel our latest meeting in Oslo that was scheduled for this June. And in our upcoming meeting in Chicago in the fall, we're also not going to be able to offer these lectures in methods and advances, as the meeting will also be virtual. However, this gives us a chance to try this new medium and hopefully reach a much wider audience with our lectures that are going to be held virtually this week. So thank you all for being here and for watching us live or watching this later on. And of course, it's very fitting that our first lecture in this series is going to be one of our founders, the founders of the society, Andrea Eisfeldt, who also as president of the society spearheaded this idea of having lectures targeted at younger scholars. And today she will talk to us about human and intangible capital and macrofinance. So the ground rules are: please keep yourselves muted. Put your questions in the chat box, and Maria Gelruth from Wharton, she will relay questions to Andrea when Andrea is ready to take them. So again, please keep yourselves muted and put questions in the chat box, and they will be answered as we go. Again, thank you all. Thank you very much, Andrea, and the virtual floor is yours.
Okay, great. Thanks so much, Nick, and everyone for organizing this. Thanks all you guys for being here. It's really great to virtually connect with the Macrofinance Society because I think it, is really important for our field and has done so much. And Nick, thank you for all your hard work. So I'm going to talk today about human and intangible capital. I'll go through some sections and then I'll stop at the end of each section to take questions. So I hope this will be interactive. And I'm not sure if Nick mentioned, but when he asked us to do these lectures, he asked us to focus more on future research questions and things that we think are unanswered and deserve our attention than tools. So that's kind of the background for what I'm going to talk about. So let me just start by saying that intangible assets are a large, growing part of firms' capital stock. So it's, of course, very hard to come up with a concrete measure of the size of the intangible capital stock, but recent papers have put that fraction of capital that's intangible at around 50%. So we sort of have this idea that intangible capital is large, it's growing. I'm going to talk as well about human capital because I think intangible capital and human capital are linked in important ways. And basically, again, just going to try to focus on future research. But of course, we always, sort of research is this collaborative effort. So we're going to build on papers that are out there. So I'm going to talk about open questions from past and present research. A lot of the papers are still working papers that I'll talk about later on. I'm going to start with some of the papers that I'm most familiar with, which are some of the things that I've worked on. Organization capital in the cross-section of expected returns, the value and ownership of intangible capital, and some links to compensation that I've thought about. Then I'm going to talk about concentrated ownership and background risk. The idea that background risk would be important for asset pricing is an idea, with a long history. So some important papers in the 90s, and I'm sure before that too, by Telmer and Heaton and Lucas. And then in the 2000s, papers by Kogan, Papanikolaou, and Stoffman, Garliano, Kogan, and Panagias, sort of thinking about background risk of innovation and displacement and the value premium. And then Haddad, concentrated ownership and equilibrium asset prices. So because of what we'll talk about, the unique ownership of intangible capital, I think it has unique implications for the kinds of background risk, the risk in the rest of the investor's portfolio that might affect asset returns. We'll talk about production-based approaches. So this production-based asset pricing started with Cochrane's papers in 91 and 92. There's important work on intangible risk by Hansen, Heaton, and Lee that really embraces this production-based methodology. And that methodology has really been taken up by people like Bello, Gala, Salamao, and Vitorino in their paper, Decomposing Firm Values. So we'll talk about production-based approaches, which I think are very useful when thinking about intangible capital, because it's so hard to measure. It helps to put some structure on that measurement question. We'll talk about measurement, and I'll talk about two papers that kind of take different approaches. One is this paper by Lee and Hall that thinks about the depreciation rate for business R&D capital and uses a very neoclassical approach. And then we'll talk about measuring intangible capital with market prices by Ewens, Peter, and Wang. And related to the Hansen, Heaton, and Lee paper, and kind of, consistent with our intuition, some of intangible capital might show up in market values even when it doesn't show up in book values. And so there's this kind of couple approaches with measurements, either starting from investment in a neoclassical capital theory model, or maybe thinking about the differences between market and book values. Okay. We'll talk about investment in Q theory. So there's very interesting recent work on the relationship between Tobin's Q and investment, and how that might relate to intangible capital as growing in importance. And then finally, we'll talk about intangible capital and capital structure. So intangible capital with its unique ownership properties, it's hard for intangible assets to be fully owned by outsiders because the human inputs are so important. And what we've seen is that means that intangible capital seems to be funded either with internal cash holdings or with employee sort of borrowing from employees by offering them deferred compensation. Okay, so let me start. I'll get into some details on these various things and talk about what I think is missing from them. So starting with the, my first foray into thinking about intangible capital, this paper with Dimitri's Organization Capital and the cross-section of expected returns. The first thing we were interested in was, how we had seen these papers, Holton and Howe, that had looked at, some detailed data on expenditures and tried to estimate the fraction of the intangible capital stock in the aggregate that was missing, and some work in the accounting literature, in particular a paper by Lev and Radhakrishnan, that was running kind of Cobb-Douglas productivity regressions and showing that using the selling and general administrative expense as a flow variable could reduce the size of solo residuals, so that there was something productive in this selling and general administrative expense. So we constructed this first estimate of the stock of organization capital using the perpetual inventory and the selling and general administrative expense. And when we thought about whether organization capitals could make firms more risky or less risky ex ante, we sort of thought it could go either way, because organization capital might be harder to reverse. So sort of like the ideas from Liu Zhang, that it would be in a conditional CAPM sense more risky, or it could offer you, more flexibility because you have this dynamic organization that's maybe better at adapting to change. When we looked at the data, we saw that firms with more organization capital are in fact riskier, or they earn alphas with respect to the common three-factor model plus momentum of 4 to 6%. And we also started to investigate the relationship between those returns and shocks that would lead to reallocation of key talent that we thought would be integral for owning and deploying organization capital. So we developed a theory that thought about this risk of organization capital coming from the fact that it can't be owned by outside claim holders. It's partly firm specific, partly general, it's portable, but it's costly to reallocate. And when these systematic reallocation shocks come, and those are correlated with capital reallocation and CEO compensations and those kinds of things, the firms with more organization capital actually have poor performance. So that's kind of consistent with this idea that the total cash flows from organization capital and physical capital might be subject to the same productivity shocks, but the share of the cash flows that the equity and debt holders can get, that share is actually subject to its own systematic shocks that come from the opportunities of the key talent that partly own that organization capital to move to greener pastures. Now, one of the sort of, kind of shortcuts that we were able to take in that paper is we knew that the selling and general administrative expense meant different things across different industries. And we, as a result, did all of our sorts, within industry first. So we didn't have to address the question of the different treatments of selling and general administrative expense across industries. But of course, it's important to think about those industry differences. So our first kind of stab at that was this papers and proceedings piece where we tried to estimate organization to physical capital across industries. But, more importantly, we really tried to estimate the fraction of organization capital that's missing from market values. So we're kind of, in a way, we're challenging this idea that using market to book ratios is a clean way to think about intangible capital, because we're arguing that the total value of organization capital, because it has these key labor or talent inputs, is owned partly by the firm, but because firms cannot fully control labor or key talent, the key talent also owns some of that organization capital. So it doesn't fully show up in market values. And we tried to think about, how much of the intangible capital stock would show up in market values. And so how effective it is to use market values as a way of thinking about measuring intangible capital. So just very briefly, this is from the JF paper, the Perpetual inventory method, and I'm going to, bring out some topics of current research here in terms of the measurement of organization capital using the selling and general administrative expense. So a couple, important details here. Selling and general administrative expense, and this took a lot of digging, so I want to make sure that everyone, is on board with this. Selling and general administrative expense, the way it's reported in CompuStat, it is inclusive of the R&D expense and the advertising expense when those expenses are allocated to the SG&A bucket. So if you want to estimate organization capital, knowledge capital, brand capital, you want to be cognizant of the fact that even when advertising and R&D are broken out separately by CompuStat, it is included in the SG&A cost bucket. Okay, so here's the equation 35 here is the perpetual inventory method for organization capital. And there are a couple interesting things to, or important things to note here. One is that you have to have a depreciation rate to come up with this current stock of organization capital. We deflate by the CPI because we know that investment expenditures are in nominal terms and that the real value of those is varying over time. The other thing that, people have pointed out is that we, because we were working across industries and because we weren't breaking out R&D and advertising expense, we used 100% of the SG&A expense because we're doing a relative sort. So the fraction of SG&A that's really investment in intangible capital, doesn't matter quite so much when you're doing these within industry sorts. But that can really be refined. And we're going to talk about, ways of figuring out, as selling and general administrative expense has a bunch of stuff in it. Some of it is investment in intangible assets that will increase the future cash flows of the firm. And some of it is, one-off litigation expenses and amortization of intangibles even. So we want to think about ways we can carefully refine that. And I'll get into that as we go forward. So the other important thing you need is some initialization. So this requires, a growth rate for that initialization. And we use 10%, which was the growth in the expenditures that we observed over our sample. And this SG&A one then is the first observation of SG&A for the firm. Okay, so the method seems fairly simple, but of course there are assumptions baked in. Once you make those assumptions, you do find very intuitive patterns for firms with more and less intangible capital. So let me just highlight a couple of things here. First, that the firms with more organization capital, they have higher Tobin's Q. So it is the case that firms with more organization capital measured using the perpetual inventory method on SG&A, they do have a higher market to book ratio or Tobin's Q. They also do have higher productivity, whether you measure that productivity using sales to book assets or solo residuals. They tend to spend more on executive compensation, more on IT. That's for a subsample that we have those IT expenditures, higher labor expenditures, and then within SG&A, are the R&D and advertising expenses. So it's maybe not surprising that these firms are spending more on R&D and advertising. And then getting to the capital structure question, they do have lower debt ratios. All right, and then the asset pricing results. I don't want to spend, too much time on this. I don't know how fashionable, as Cam Harvey would say, blah, blah, in the cross-section of expected returns is, but we know that organization capital has unique risk characteristics that are not, soaked up by loadings on standard factors like the market factor, SMB, HML, and momentum. So we have these long, short, high organization capital, long side, low organization capital, short side, alphas of, between 4 and 6%. Okay. Let me stop there and see if there are any questions so far. Maria?
Hi, no, I do not see any.
Okay, so feel free to put anything up in the chat and I'm gonna stop in another few slides. Okay, all right, so, we're going to argue that key labor capital or organization capital has two distinguishing features. It's partly firm specific, it's partly embodied in key labor inputs. And we're going to argue that that drives a lot of the important, stylized facts that we can document concerning organization capital. In terms of valuation, the fact that it's partly firm specific, partly embodied in key labor inputs is going to mean that in terms of cash flows, the share of cash flows that financiers can accrue is limited. So, I wanted to mention this one idea for future research that, I was never sure, how to nail this down, but I always thought, when Hall wrote about intangible capital prior to the tech bust, he had argued that kind of the lack of accounting for intangible capital was why we had these high valuations of internet firms in 99 and 2000. But then when the tech bust came, everyone said, well, no, because if it was intangible capital, it would have shown up again. And I think one of the things that argument ignores is that, there were a couple things going on. Prior to 2000, we sort of thought we could finance all of intangible capital, with outside equity. And I don't know how sophisticated the deferred compensation and sort of golden handcuffs were. And so it's not clear that the value of that intangible capital disappeared, or it just, stopped being captured by outside shareholders and started to get captured by more and more by the key talent within the firm. So one idea for future research. So the other thing that this split between key talent and outsiders can affect is discount rates, and that's because this sharing rule is subject to systematic shocks. When the outside option of key talent is higher, that means they're going to accrue more of the rents. So just very basically, if we have this, this valuation, this is the total value of the firm's physical capital and organization capital. And the organization capital in green is owned partly by the key talent, that's the light green. It's partly owned by shareholders, that's the dark green. The shareholder value then is the sum of these two segments. So they own the physical capital and they own the fraction of the organization capital that key talent doesn't own. So one of the things that I would love to see going forward, and I would love to see what other people do with this, is there's clearly a link between the value of the organization capital that the shareholders own and the compensation of the key talent. So we had documented some basic stylized facts about CEO compensation. There's some stylized facts in my recent work with Falato and Xiaolan on the selling and general administrative expense and equity-based compensation. But the tight link between, the compensation of key talent and the value of organization capital within the firm, I think is still a really interesting open question. And that gets to compensation issues, wealth and income inequality issues, and also capital structure issues. And I'll mention later the paper by Sun and Xiaolan that is about financing intangible capital by borrowing from workers. Okay, so just to get something concrete on the table about this important idea of the shared ownership of organization capital, I'll put the very simplest model on the table. So there's this static model that I use in teaching. There's a very simple option theory model in the P&P piece, and then there's some more bells and whistles in the model in the JF paper. And that JF paper, links the payment to key talent to the sharing rule, and kind of digs into the sensitivity to the outside option and the effect on asset pricing. But the idea about this fraction of intangible capital that's owned by the firm and the shareholders and debt holders versus the workers can be pretty well captured in a static model. So we're going to think about a world where each firm is endowed with two types of capital. They have KI units of physical capital with efficiency 1, and OI units of key labor capital or organization capital with efficiency epsilon I. They operate one period and they maximize free cash flow. Production's linear and each input inseparable. This is another area where I think future work could really help us out. We really shouldn't believe that physical capital and intangible capital are separable. Again, in the work I have on human capitalists, we see that high-skilled human capitalists and physical capital appear to be complementary, in particular in industries where you've had capital prices declining a lot, and those are the high-tech kind of industries. So thinking about the shape of the production function when you have intangible capital, I think is really important. And then I'm going to talk a little bit about the link between intangible capital and measurement of markups and how we can think about rents and market power. When you have intangible capital, I'll just mention it really changes your inference about markups and those kinds of things, probably not surprisingly. Okay, so key labor capital has limited liability. It has the option to reallocate to the frontier efficiency X, and there's a reallocation cost. So that reallocation cost is sort of the firm specificity of this organization capital. The firm's shareholders' problem is to maximize their value, and that value is super simple. It's just the value of physical capital with efficiency 1. And then whatever is bigger, the value of the net cash flows from organization capital, which is the stock times the efficiency epsilon I, less what you have to pay organization capital WI, or zero. And at some point when the wage that has to satisfy the participation constraint, the organization capital needs to be paid more than its outside option, which is the stock of organization capital times the efficiency it can operate if it moves to the frontier efficiency less the reallocation cost. When that outside option is too large, then the firm will just let the organization capital go, and that shock X is the systematic shock that really governs the sharing rule. So the solution to this very simple problem is that there's a threshold X upper bar, which above which that when that efficiency gets that much higher than the firm's specific efficiency, you allow reallocation. Here that X upper bar is given very simply by the firm specific efficiency plus the cost of reallocation. And you're going to reallocate when the improved efficiency recoups the cost. So very intuitive. The total value of the firm is the physical capital plus the organization capital. And the value of the shareholders' claim is the physical capital. They own 100% of that, and that's, depends on the separability assumption. And then they own the fraction of the organization capital that is not owned by the key talent. The key talent owns the organization capital basically up to the value of their outside option. So the fraction of total capital that's not in market value, and again, we're thinking about, is market to book, a good kind of measure of intangible capital. Well, this fraction here at the bottom, which is, organization to total capital multiplied by something that describes the sort of moneyness of the outside option, shows you what doesn't show up in market value. And so these last 4 points are just comparative statics that are going to tell us when market value relative to book value is going to be a less accurate measure of the total value of organization capital, because the part that we're missing, the part that key talent is taking home, is going to be larger. So that fraction that key talent owns is going to be increasing in the ratio of the book values of O over K. It's going to be increasing in the frontier efficiency relative to the firm's efficiency. So whenever actually we have, this frontier efficiency, the outside option of key talent going up, and, and market values tend to go up during these kind of high CEO compensation, high capital reallocation, sort of more excited financial markets kind of time. Actually, as long as some of that excitement is because of frontier opportunities for key talent, that actually will reduce the fraction of intangible capital showing up in market value. And then, of course, as the cost of reallocation goes down, the fraction of organization capital that's going to accrue to key talent is going to go up. Okay. And just bearing in mind that cost of reallocation can be technological or financial. So, when we decided, we could let early stage internet firms IPO, or we had an improvement in venture capital or private equity markets, or more liquidity in those markets, or more funds allocated to those markets, that is a reduction in the cost of reallocation, and that would lead to an increase actually in the part of the organization capital that's owned by key talent. Okay, so let me talk, just summarizing, thus far, about the implications, broader implications in future work. So in terms of broader implications, we have these impact of this ownership sharing rule on the aggregate value of organization capital and any kind of intangible capital that's really tied closely to human inputs. The aggregate values will move over time. the industry values will move over time, and the firm value to outsiders might move over time and might also move to the over the life cycle. So, you know, when a founder starts a firm, they're integral to that firm, and it's very hard for them to raise claims against, you know, their own human capital input. And when they want to sell claims to outsiders, they have to somehow, you know, codify that organization capital and make it, you know, be able to be owned by outsiders. So I think that idea of somehow codifying organization capital is important. There was that big question about, you know, what Apple was going to be without Steve Jobs, and there are a lot of, you know, cult of personalities with tech firms that, you know, make you wonder, you know, about this codification of organization capital. It's an important part of firms' life cycle. So there are implications for risk sharing, implications for the income and wealth distribution. If organization capital has to be closely held, you know, that's a background risk that we got to think about when we do asset pricing. If it needs to be closely held, then that may explain some of the stylized facts about the wealth that has accumulated from ownership of firms that people work in or founded or are CEO of. There's implications for capital and income tax policies. Those are going to depend on all of these, you know, questions about separability and who determines investment in organization capital. And this idea of investment or organization capital, let me point that out as an additional hole in the work that we did. We assumed that the investment in organization capital was undertaken to maximize the total value of the firm. But that, you know, that assumption is maybe, you know, not always the most realistic one to make, because if the firm's shareholders want to invest, if the firm's shareholders make the investment decision in organization capital, you know, they would take into account that they don't want to, you know, maximize the value of this outside option, and they would take a different investment decision that if the organization capital itself, you know, made the investment decision. So there are some interesting agency problems there too. And I believe that Colin Ward has worked a bit on those. And I should have cited him here. I apologize, Colin. Okay, so future work more specifically, again, things that are missing. Some of these things we'll talk about as we go on with the lecture. One is to refine the SG&A cost bucket. So you just want to think, if you're accountant for a firm, you have all these costs and you don't want to report too much detail because you don't want your competitors to know exactly what you're doing. So it might be an industry standard to report R&D separately, or it might be an industry standard to report advertising separately, say if you're Coke and Pepsi. But a lot of times you're just going to have these two big buckets, cost of goods sold and selling and general administrative expense. And we really want to refine what's in that SG&A expense to isolate investment in intangibles. So in the appendix, the online appendix to our JF paper, you know, we went through a large number of 10Ks and listed in as much detail as we could and categorize the kinds of things that were falling under SG&A as far as we could glean from the managerial assessment of risk section 7. But I think there's definitely more work that can be done there, especially with modern data scraping and textual analysis tools. We can also use structural models and reduced form models to come up with this better measure. And that's just using the perpetual inventory method, but refining our inputs into that. I think there's a lot of work that can be done to link intangible capital to the firm with the key talent values. So linking more to compensation data, in particular equity-based compensation and deferred compensation. And then I think there's definitely more to be done on the unique risk exposures of intangible capital. We really focused on this one, which is the sharing rule of the cash flows from organization capital with the key labor that's important for that intangible capital. But I'll mention, down the road some of the sensitivity of certain types of intangible capital, maybe to innovation risk and those kinds of things. And I think, that's an open area. still. Okay, so let me break again, Maria, and ask if there are any questions.
Yeah, there are a few. So first, there's a clarifying question. One sec. Yeah, so could you please explain the difference between labor capital, organizational capital, and human capital?
Sure. So I feel like I'm always working on these topics with loose definitions. And, you know, definitions that you know, you really need a model to make something very concrete. So, you know, when I was working on liquidity, I kind of felt the same way, that it has all these different meanings. And intangible capital, organization capital, I use the word key talent capital, high skilled labor capital, all seem kind of closely related. So in the context of the models that I worked on with Dimitri's, organization capital had a very specific definition, which is, you know, it's capital that is tied to key labor inputs, that is partly portable and partly firm specific. Now, I think that decomposition could be done in different ways depending on the kind of measurement that you wanted to do and the kind of model that you want to write down. So I think what you're seeing in this sort of, you know, unfortunately not crystal clear definitions or demarcations of intangible capital is that, you know, I don't think we, you know, we have settled on exactly what types of intangible capital are the most important, and are they, and how are they related? So things like knowledge capital, brand capital, labor capital, human capital, organization capital, I think they're all kind of pretty closely related. So I think, you know, the fact that those are not crystal clear yet, I think is reflective of the amount of future work that, you know, needs to be done on this topic. But we had a very specific idea for organization capital, which is, you know, this type of capital that you invest in by investing in your workers, in R&D, in your brand, but that cannot be fully owned by outsiders, because the people who are working with it and developing it every day, you know, are kind of necessary for its deployment.
Yeah, there are a few more questions. So one is from Jiro Yoshida. Does your framework have any insights into decreasing aggregate labor shares and the compensation for CEOs and managers?
Yeah, so I'm going to talk next about compensation, and I think that you know, I think there's definitely an interesting connection between the rise of intangible capital and the declining labor share. Let me talk about that, because I have some specific work on that. It's not the, you know, the last word on this question, because that work is really about high skilled labor, just correctly measuring the compensation. But I think there's a lot to be done there. You know, when I think about the way the labor and capital shares are measured, sort of, you know, Y equals RK plus WL plus, you know, some profits or something like that. This RK is using, you know, physical capital. So all in this kind of, you know, it's kind of like almost like debt payments, and this is kind of like dividends in a way. And so, you know, just the fact that we have more intangible capital and we have more equity financing, and, you know, what I'm going to focus on is that we're not even measuring this W right. I think that there's a lot to be said there. Not to mention the fact that once you include intangible capitals, anything that has to do with measuring markups, you know, will be affected. And one more thing in case I don't get to it, you know, thinking about, you know, this profit share or markups, the most, you know, as far as I can tell, the kind of paper that people rely on for the dynamics of markups is this Eckhout, it's Jan and Jan, and I think it's Eckhout, and I'm forgetting the second author, I apologize. that paper, and it was a student at Chicago that first pointed this out, basically uses the fact that revenue minus COGS has been growing over time to say that markups have been growing over time. Well, if SG&A is growing as a fraction of total costs relative to COGS, then you're basically, going to call that markups increasing. So I've kind of given you a spaghetti soup of things to think about there, but thanks a lot for asking the question.
Okay, the next one is from Alessandro Ribucci. He's asking if there are any implications specific to banking industry and market structure.
Oh, banking industry and market structure. Yeah, so that is a very interesting question. We'll talk about the differences across industries, as we go on. Finance is one of the industries that, has the highest organization capital when you measure it using SG&A, and, has this very interesting market to book dynamic. So when I worked on bank valuation, the aggregate market to book ratio of banks was like 2 in 2006, and then it was below 1 in 2008, 2009. And, that's pretty interesting for an industry where a lot of the assets are, you can mark them to market. So when you think about market to book ratios, sometimes being because of stale book values, that's not so much of an issue for the finance industry, but the market to book value varies a lot. And, that part of that market value is franchise value, and that's growth opportunities, that's the brand and organization capital and any technology too. But some of it for sure in finance, and that would be a super interesting place to look at the sharing rule of the rents from organization capital, because we know that's one of the places that compensation rose a lot. There's work by Josh Rao with co-authors that thinks about the importance of the finance industry and income inequality. So yeah, couple of thoughts on that, the banking industry.
Okay, so the next question is from my fellow student Felix, who can ask his question himself because it's quite long.
Hi, Andrea, this is Felix. So it's not that long, it's just more a clarifying question in the sense that you had this pie chart, which was basically showing the free sections. And I was wondering, to me, it's not quite as clear cut, because if you reduce ownership of insiders, you will also take out their alignment of interests with outside ownership. So if we think about shocks to inside ownership, such as stock vesting or any options that are expiring or lockup periods that ends, notably for startups, then we would to me, it's not quite clear that the pie would actually just the size of the pie would not be affected by the fact that you reallocate the parts. And so I was wondering whether there is a way of thinking about how those two inside and outside ownership actually interlink, and whether people have looked into that.
Yeah, that's a really interesting question. So, maybe just to not have things be too complicated, we didn't have those kinds of agency problems. So if you think about the kinds of things that link compensation to incentives, there's the participation constraint and the incentive constraint. And we thought much more about the participation constraint being important in determining the equity or the pay, which, because it's sensitive to firm value, it certainly makes sense that it would be done with equity. But the incentive constraint is probably really important too. And I will have that as a future research question that I think, it's kind of, it's not one or the other, but it's sort of, when is the incentive constraint more important and when is the participation constraint more important? Because I certainly agree, if you don't give people, especially the key talent near the top, the, ownership and pay sensitivity that they wouldn't put in the same effort that they would otherwise. So yeah, that's an open question. And I don't have it in the slides, but there's a paper by Colin Ward on agency theory and intangible. So that's the one place that I would look, and he probably has some sources there. But again, this link between the deployment of organization capital the way compensation is structured, I think is a pretty open question. So one thing that I think is very interesting about all this compensation is it is deferred, a lot of it. So it either has this vesting period or it's deferred compensation literally. So you do have, when organization capital is important, you have this important golden handcuff, or whatever you want to call it, aspect to compensation that seems to mean that, you know, the firm knows that these people leaving would sort of destroy a lot of firm value, and so they keep them around because they can't collude. You know, they've gotten in, some of the tech firms got in trouble for not colluding to, you know, take each other's workers. They keep their workers by structuring compensation in this deferred format. Yeah, it's a very interesting question. Thanks, Felix. Thanks a lot.
Thanks for answering.
Yeah, if people do raise their hands, it is nice to see the faces. I wasn't sure how, you know, easy it would be for Maria to handle that, but if it's easy to unmute people and let them get on screen so I can meet them, that sounds great too.
Well, in the meantime, I can ask the next question. So the next one is from Anand Sisla. Could you please talk about how Epsilon, organizational capital efficiency, is being measured?
Yes, Epsilon, the firm-specific efficiency. Yeah, so that is, we focus really on calibrating the distribution of the Epsilon so that we match reallocation facts. So we're calibrating the outside option and the distribution of the firm's specific productivities of organization capital relative to that frontier efficiency, using data on things like IPOs, CEO compensation, capital reallocation, and the difference in returns between high organization capital and low organization capital firms over time. Yeah, it's maybe a hard variable to get a firm specific measure for. But, you know, there would be other ways of doing more standard sort of solo residual or those kinds of things to get at that.
Okay, the next one, oh, I can also turn on my video. So the next one is from Cameron Pfeiffer. Are there any interesting studies on heterogeneity in production technologies and organizational capital? Because the expectation would be that the short run production technologies would differ, so there is a potentially more interesting labor organizational capital dynamic when key labor can choose which firms to allocate to. So,
yeah, so I like the work that I think is related. I don't know how closely. I think they think it's fairly closely related, but by Tate and Yang. So Jeff Tate and Lou Yang, that works on labor reallocation, sort of within and across firms, and the productivity of that labor input and how it relates to the reallocation. There aren't a lot of studies, you know, really thinking about where key talent chooses to go and how that affects productivity or value of firms. So I think that also is a pretty open question, and it is, you know, that labor markets are you know, I think are very tight where organization capital and high skilled labor are very important. So really, you know, thinking closely about those labor markets and how the dynamics of those labor markets affect compensation and firm value together, I think would be very interesting. My guess is there's probably some work in labor economics that I won't be as familiar with on the compensation side of it, but that they may not have made the link to the firm value or the finance side of it. So it's a great question.
Can I jump in quickly with a follow-up question since you touched on this topic of labor markets? How do you think of non-compete clauses and their enforceability, and whether they should even be enforced? I mean, if you take kind of a normative hat from the standpoint of that kind of model, can we say that, well, should there be non-compete clauses? Should they be enforced? And also, can you use variation, and to what extent they're enforced, like in just Jeffrey's work, to measure maybe, again, organizational capital and risks of kind of this embedded organizational capital?
Yeah, that's a great question. There's Jess Jeffers' work. There's some older work too, comparing, you know, kind of, I think Massachusetts and California have different enforceability extents, and I know people have looked at, you know, the way that that affects innovation and all of that kind of thing. So I think that is really interesting. I don't want to make any normative statements. It's not something that I thought about. It's a hugely important question. So I'm going to stay away from that landmine. Yeah, but just kind of, I think it's important. Thank you, Nick, for mentioning that prior work, because it's certainly, you know, there's compensation as a way of keeping your talent with the firm by deferring it, making it conditional basically on staying. And then there are these non-compete clauses of varying enforceability. And it is interesting to think about the cross-section variation in those non-competes, you know, and kind of the time series. And it is a very important policy question, kind of just like with patents, like how much of your key labor talent should you be able to own, and, you know, from a social value perspective. And that's kind of how it links also to the taxation question, because taxes are a way of not letting you own that fraction, right? The government owns that claim. Yeah. Yeah, thanks a lot, Nick.
Sure. And I think the next question is about patents, but I'll let Maria relay.
Okay.
Yeah, it's just, so it's from Wenbo Wu. Would you count patents as physical capital or human capital, because patents are tradable?
Yeah. I do think that patents are one of the types of intangible capital that are easier to have claims to. They're tradable. There are markets for patents. So I think, you know, once an idea has become patentable and is sort of being used in production, that is, you know, one way of codifying and making it available for outsiders to own, and probably allowing it to show up in market value. And that's actually something that my co-author, Dimitris Papanikolaou, has worked a lot on.
Okay, that's it for now, I think.
Okay, good. Thank you. Please keep them coming. It's really great to hear. I love interacting with PhD students and teaching PhD students, because you guys always have the, you know, sort of newest, best ideas. So I really appreciate the feedback for me too. It's very inspiring. Okay, so I'm going to talk a little bit about compensation and labor share. I have, you know, ongoing work with Antonio Filato and Manish Aulan, in which we document the importance of what we're going to call human capitalists. So again, this is a term that needs a definition. These are employees compensated with firm ownership. And we call them human capitalists because they're just like regular capitalists in that they own private factors of production. But the difference is that they own those private factors of production due to the fact that they've been compensated with equity. And the really key contribution of this paper is that it's very difficult to measure equity-based compensation, in particular below the C-suite, but it appears to be hugely important. One implication of that is that the labor share that's used in most studies of factor shares is mismeasured. Most of those studies are based on BEA and BLS data, and I'll talk in detail because it's very important to understand why those sources don't capture the majority of equity-based compensation. And then, you know, we develop a theory where physical capital and human capital can be complementary in production, and we estimate the degree of that complementarity. And as I previewed, I'll provide some evidence at the end of this little section. There seems to be a high degree of complementarity, you know, kind of as you might expect, between high-skilled labor and IT capital, the kind of physical capital whose price has been declining a lot over time. But the surprising thing is that if you don't include equity-based compensation and you use wages alone, you don't see evidence of that complementarity in recent years, just because over time, it really looks like there's been a substitution from wage-based pay to equity-based pay. And an open topic for research, one that we don't address in this paper, is why that has been. You know, has it been because of outside options and participation constraints? Is it due to incentive constraints? It actually, you know, looks like, and I won't have time to talk about this part of the paper, it looks like a lot of the, you know, rather than increasing the compensation to high-skilled labor overall, it does look like the equity-based compensation just has been, you know, substituting for wage-based compensation. That's another reason it's so important to measure that equity-based compensation when you're thinking about labor share, because there's just been a substitution away from the kind of compensation that shows up immediately on W-2s. Okay, so this is a graph within the merged CompuStat NBER CES sample that we use for a lot of our empirical work. We do that because the NBER CES has very, you know, solid measures of value added and also of wages, which is difficult when you're working with CompuStat data. So because the CES sample is a little more manufacturing heavy, it's very broadly defined manufacturing. So I believe like Apple would be in there. It's a high-tech firm, but it makes stuff. You know, the level of the labor share is lower, but the trend looks like the trend you see in all other data, which is that the labor share is declining over time. And that's true even when you use the NBER CES decomposition between production and non-production workers. So these non-production workers in the labor literature, people have worked on, you know, how good of a definition of skilled labor are these non-production workers, and have some convincing evidence that it's a decent measure of skilled labor, whereas the production line workers, they've identified as the lower skilled labor. You see in the blue line that isolates the high skilled labor share, you know, maybe a slightly smaller decline. The right-hand axis is connected to that dashed blue line, but you do see a decline in the high skilled labor share. And this is kind of, you know, a surprising fact. We thought, you know, sure, we've seen the low skilled labor share decline. Maybe that's because some of the production line workers or low skilled labor workers have been replaced by machines. But, you know, as we have more and more sophisticated machines replacing labor, we might have expected that the high skilled labor that's maybe complementary or necessary to operate those machines would have actually been at least stable over time or even increasing. But you see that, you know, just using wage data alone, the high skilled labor share is also decreasing. So we're gonna do really a large part of the paper is just a really nitty gritty measurement exercise. We're gonna say there are two parts to human capitalist income, their wages and their equity-based compensation. And that equity-based compensation is human capital income from the ownership of private production. So that's what makes them capitalists under standard definition. They share in firms' future profits like financial capitalists. And the key thing about this kind of compensation and what makes it hard to measure, and the reason that it is missing from BEA and BLS data, is that it is either deferred, so it has a vesting period, or it's in a deferred account, or it's qualified, meaning it is an incentive stock option or qualified as incentive-based pay for tax purposes, meaning it can be taxed as capital gains rather than income. These two features are going to mean that the majority is not in compensation data, and both of these features are actually going to be important. So some of the punchlines of the paper are that the second part, this equity-based compensation, is really important. It's growing. Reserved shares to market cap is large. It's 7%, and that is, if you think of that as a proxy for high-skilled labor ownership of firms, that's can be, kind of compared to 2.2%, the ownership of publicly traded firms within the C-suite. And these reserve shares, which is what we base our main measure of equity-based compensation on, just so I can give you an idea of why that's a useful measure of equity-based compensation. Firms, when they meet with their board annually, they will reserve shares for employee compensation. That is a variable that's available in Compustat for the majority of our sample. They are required to disclose the shares reserved for compensation. The reason is because if they don't do repurchases at the time they issue the shares for compensation, that is going to dilute the stake of their existing equity holders. So as you can imagine, it's their fiduciary duty to report these reserve shares that will eventually lead to share issuance. We show that, indeed those reserve shares are linked to things like repurchases. So firms do try to offset the dilution that's caused by employee compensation by equity. It's also related to the difference between diluted and non-diluted earnings per share and things like that. So the basic idea is that to tell their shareholders that potential dilution is coming, they need to alert them to the shares they reserve for employee compensation under their employee compensation plan. They don't want to over-report this because that would just lead their shareholders to think more dilution is coming than is. But they don't want to under-report it because they are legally required to disclose it. Okay, so it's large. It totaled $90 billion annually in 2005. It represents 9% of value added. That's up from 1% in 1980. So that's just, that's a huge change in the share of value added. It's 45% of high-skilled labor income in 2005, up from 6% in 1980. And so that's kind of tells you, when you think about compensation to high-skilled labor, it used to really be mainly wages in the 80s, but this compensation in the form of equity has just been increasing. We've spent a lot of time thinking about that for CEOs, but it's really important below the C-suite as well, and that has implications for participation constraints, incentives constraints, wealth inequality, income inequality, background risk, a lot of the things that we've talked about. If we include that equity-based compensation, we can cut the measured decline in the labor share by 60%, and we can reverse the decline in the high-skilled labor share. Okay, so let me, because we're going to get a break, I guess, after the next round of questions, I'll kind of get into some nitty-gritty details with you guys, because I think it's really important. So there will, I hope, be, future work on this important topic of getting a handle on this equity-based compensation. It's not to say that it's not something that the BEA and BLS have not thought about. They have, in particular in the late 90s, the BLS was doing surveys on this. We've had several conversations with the staff, and they're very thoughtful about equity-based compensation, but they're just very cognizant of the challenges in measuring it. And they have to deal with private firms as well. We're only dealing with the publicly traded universe, and that's, I'll talk about that when we talk about future work. So standard sources for the labor share include exercise. This is what they include out of total equity-based compensation. So they include exercised, non-qualified options only. Between 1/2 and 2/3 of options are non-qualified. So that 1/2 and 2/3 depends on whether you calibrate the fraction that is non-qualified, meaning the stuff that would eventually show up in W-2s as labor income once it is exercised, as opposed to the part that will only be taxed as capital gains, the ISOs, the incentive stock options. So 1/2 to 2/3 are non-qualified, meaning they will show up in W-2s once they're exercised or once the vesting period is over. 1/2 to 2/3, that depends on whether you calibrate the number to the split between NSOs and ISOs for the C-suite, in which case you get 2/3 are non-qualified, or you calibrate to the BLS's surveys in the late 90s, in which case you sort of see that 1/2 only a half are non-qualified. Okay, the average vesting period is 5 years. That's going to be important because, you know, even if 100% of these equity-based pay, the options are going to show up in W-2s, they're not going to show up until 5 years later. 5 years later, the base has grown a lot because the growth that we've seen is you know, more than linear. And so when you look at, you know, a half or 2/3 of total grants getting exercised 5 years later, that fraction is a very small amount of current equity-based compensation, which is what you want to measure when you're thinking about a measure of value added. You want the flow that was given this year for marginal product produced in this year. Okay, so I don't know if I need to go through, you know, the details from the BEA and BLS, but this is just, you know, a little bit of their technical white papers that kind of verify that what they have included is wages and salaries in cash. It includes employee gains from exercising non-qualified stock options. Incentive stock options, which are a half to a third of all options, do not require the reporting of additional income. The data required for treating NSOs as compensation when the options are granted are not currently available. So they're just acknowledging that this is a problem, but in telling you what they are including. So NSOs are valued at the time they're exercised, and they're not, and ISOs are not included. For the BLS, they use a different source. They're using the QCEW, which is the Administrative Tax Records of the state unemployment insurance programs. It also only includes taxable wages. And they say that even these unemployment records are likely to understate even the exercise value of NSOs, just because of, you know, states just vary in the quality of the reporting. So this is to say that, you know, we're going to try to give a best case scenario for where these standard sources account for 2/3 to 1/2 of non-qualified equity-based compensation, meaning stuff that will eventually show up in W-2s, but account for the fact that it's deferred, and then also account for the fact that then 1/3 to 1/2 of all equity-based pay is incentive-based or ISO qualified for tax purposes and will never show up on W-2s. It shows up on other tax forms that are then used to assess capital gains taxes. So here's a very simple stylized example of what happens when this equity-based compensation is growing as quickly as it is and is deferred, and, you know, some of it is going to show up in W-2s because it's not qualified and some of it won't because it is qualified. So it's a stylized example in which we're going to assume total new grants grow at a constant rate. We're going to use the average growth rate of 20% in the data. And so, you know, stylized example, just calibrated. 1/3 are ISOs will never show up in W-2 based compensation measures. So those are the incentive stock options that are taxed as capital gains. 2/3 are NSOs with an average vesting period of 5 years. And then 100% of the vested NSOs are exercised immediately. So we want to, you know, allow for the majority of the equity-based pay that could show up in these W-2s to show up. In this example, 75% of new grants will not show up in contemporaneous W-2 based compensation. So there are these, again, these two important effects. The first is that they're the ISOs that will never show up. So those are, in this example, 1/3, but they could be as large as 1/2. But the second really key thing is that because we have been in a transition period, we're not in steady state. We're going through a transition where we're moving to from basically 0% equity-based pay to something like 50% equity-based pay, that when you think about what is showing up in W-2 data today, that is the exercised portion of non-qualified grants that came 5 years previously, which of course is a much smaller base because of this high growth rate. So this is just to illustrate, you know, kind of the you know, nitty-gritty drivers of why this type of compensation is missing from standard sources, despite the fact that these are very talented agencies in terms of measurement. So here's our estimate of the share of equity-based compensation as a fraction of value added. And again, when you think about measuring value added, you really want to get at what is the, contribution to current income or current marginal product from inputs that were deployed, within the period, within that year. So you want what grants were made this year as payment for inputs, labor inputs that were provided for marginal product this year. And this is what we find, kind of 1% in 1980 to 9% in the 2000s. So it's a very big increase over this time period. One thing I want to say that, I didn't put in the slides, but I like to mention, when I talk about this paper is, thinking about equity-based pay and compensation and marginal product and the fact that some equity-based pay is really given for incentive reasons or participation constraint reasons, that delinks this kind of standard assumption in macro where output and income are kind of equalized over the year. Because if I'm paid my outside option this year, and that part of that compensation is in firm value, and firm value is derived from cash flows coming down the road, it's possible that total compensation exceeds current income in some periods, and then is less in others. So this fact that you're delinking really marginal products from income, kind of makes you rethink some of those even more basic assumptions. But again, we actually, in the end, in our exercise, we find that it looks like the majority, like 90% or more of equity-based compensation is for marginal product. And it's not that, on average, these workers are accruing, more and more rents. I have been, it's not to say that 10%, if that's the number, is not economically significant. Okay, so this is what labor shares, high-skilled labor share looks like if you include equity-based compensation. So we start with that blue line here. We add the equity-based compensation, the annual flow of equity grants with the black line, and then we get a total high-skilled labor share in the red line. And we can see that, including equity-based compensation completely reverses the downward trend in the high-skilled labor share. It does also cut the total labor share decline by 60%. So this is a big deal, not only just for high-skilled labor share, but also for the total labor share, of which high-skilled labor is one component. Okay, so last thing I'm gonna bring out from this paper, because I think that there's additional work to be done in this area as well, is the complementarity that we see between high-skilled labor and physical capital, and the substitutability that we seem to see between physical capital and unskilled labor. So I am going to just highlight this one column in the interest of time. We're just looking at equity-based compensation as a share of value added. So the new grants each year relative to value added. And these are industry level regressions. We see that in the industries in which equity-based compensation has become more important, so think about the industries, where capital goods prices have declined by more, high-skilled labor has become more important. We see that we have more investment in physical capital, but a lower low-skilled labor share. So when we think, I just want to bring this back to, structural models. How do we get at measuring intangible capital? Well, it's tough without some structure on the problem. But the structure, probably needs to have some richness to it. So having perfect substitutability, so separability, isn't going to work. It seems like we have this complementarity between at least high skilled labor and physical capital. So certainly probably between physical capital and intangible capital and different forms of labor. So the shape of the production function, I think when you have intangible capital, that is an area for open for research. And I'll mention one paper in a little bit that's taking a stab at just one aspect of that question, but it's just, kind of wide open. Okay, so just like a list of maybe some things we can talk about in addition to things we covered already. Future work I would be super excited to see would connect equity-based pay to organization and intangible capital. There is the paper by Sun and Xiaolan that's talking about financing intangible capital and has some evidence that intangible capital investment and equity-based pay are linked. But I think there's, definitely more questions to be addressed there. Connect equity-based pay to income and wealth inequality. There's this sort of, in the background of all the labor share work, there's this, kind of underpinning of thoughts of inequality and declining labor share and capitalists earning rents and so on. And, the fact that these high-skilled laborers are sort of, they may not have a choice but to be paid in equity, but, over the last, decades, that actually has turned out to be, not such a bad thing. So there's definitely a link between equity-based pay and income and wealth inequality. And we already know that stock market participation is heavily concentrated towards the top, and then we have this additional sort of force that even, your income is coming in the form of savings in a sense. More on the shape of the production function we talked about, equity-based pay and international data. I haven't seen yet equity-based pay in private firms. There's some, there are these interesting kind of compensation databases that are available online or collected by private firms to, help people decide where they're going to work. I think equity-based pay could be even more important in private firms than public firms. And then this question that Felix and others brought up, this equity-based pay, is it just a substitution for wages because it's a way of borrowing from them, as in Sun and Xiaolan? Is it to satisfy incentive constraints? In the Ward paper, there's an important agency problem with investment in intangible capital and how the workers are paid, or this participation constraint. So, we worked a bit on how the participation constraint affects the sharing rule and the risk to firm value, et cetera. But I think there's a lot more to be done in terms of really nailing down empirically the role of the incentive and participation constraints in equity-based pay. And again, in this paper, we document this huge rise in equity-based pay below the C-suite, and we use a participation constraint to allow for marginal product to be delinked from compensation, but we don't address incentive constraints versus participation constraints. We do have an estimation exercise where we try to estimate how much of equity-based compensation is just replacing wages as a payment for marginal product versus satisfying outside option. And again, we got that 90% marginal product, 10% outside option split. So let me stop here. I think we should take some questions and then, have our break. I would love to hear from you guys. See anyone too? Maria, you want to take charge?
Yeah, there is one. Oh, no, there is another one. So there is one question from Anna. She's also our PhD student. How should we think about risk and equity-based compensation? For instance, employee leaving the job early or being fired and never making it through the vesting period. So how should we think about risk and equity-based compensation when constructing the combined labor share based on risk-free wage income and deferred compensation?
Yeah, that's a great question, and it often comes up. So wages have some systematic risk in them too. We don't account for that. We don't account for the fact that the that equity-based compensation may have different discount rates and different risks than the wage-based compensation. But I think it's an interesting question. It's something that's been the subject of a lot of work in the CEO compensation literature. So you can stand on the shoulder of giants and think about that. I think it's definitely a good question. And I think you're bringing up something that I hadn't really thought enough about, I think, which is, I think we thought about the risk in equity-based compensation being tied to firm values, but I wasn't thinking as much about the risk of, that compensation evaporating should I leave the firm. Now, maybe that's because I thought, I'm thinking in terms of the models where I only leave if I earn more in my next job. But I think that's really to think about. There is some data actually, when you look at the reserve share data and maybe in some other data sources too, where you can see, when someone leaves the firm, then those options are canceled and the shares can, reserve shares can be taken out of that liability section. And so there may be a way of thinking about, turnover and equity-based compensation being lost that I think, that sounds really interesting.
Thank you. There is a question from J.E.M. There are actually two questions. So equity-based pay ratio measure jumped mostly in the late 1990s. So the first question is, what do you think is the main driver of secular jumps in the years around to 2000? Mm-hmm. Yeah, and then I'll ask the second one.
Okay, yeah. So again, in our model, we're not thinking a lot about the driver of the split. We just have that one exercise at the end where we try to think about how much is for marginal product and how much is for outside option. That we're assuming that's kind of, also we don't think about how that might change over time. So Mindy has that other work that I've mentioned a few times on financing intangible capital. And it may be that, firms started using equity-based compensation when they found it difficult to issue claims to external stakeholders. And so they thought, well, because this type of capital's, tied to our workers, maybe we should really allow, they own part of it already. Let's have them own, a little more. That'll help to align incentives and it'll help to keep them around. But I think that's true. It really took off in the 90s, was really negligible in the 80s, but has really been growing since then. And we've done some work. We actually had to hand collect the data from 2005 onwards because of the way CompuStat, kind of changed their data collection method. So we're working to see, what has happened since 2005. But I think that period in the 1990s is very interesting. And I'm hoping, given the data collection efforts, that the recent data is also super interesting.
Oh, you just answered the second question because it was about what happens after 2005. Okay, so the next question is from Stefano Lord. Is there any way of incorporating or differentiating in uncertainty instead of risk regarding wage income and compensation?
That's a good question. I probably, not going to give a, particularly intriguing answer. I think that thinking about, uncertainty or sort of unknown unknowns or, robustness and those kinds of things is really important. But I haven't worked on that. I think it, probably, the standard things I would think would apply, we need lower risk aversion to explain, kind of the way we discount uncertain cash flows. But I haven't thought about it beyond that. I do think it's, it's a good question.
Okay, the next one is from Adita Chaudhry. Have you thought about firms moving to equity-based compensation as a way to match the duration of financing their stock of labor with the revenues who they will produce?
I haven't. That's an interesting idea. So there are all these interesting papers in asset pricing about the duration of cash flows and discount rates, and And then this question about, you know, kind of marginal product versus income, and, you know, what does it mean when income includes part of firm value, which is future cash flows. So I would welcome an exploration into that topic. Sounds like a great idea.
And I'm guessing that's the last question also from Adita. So related to that, to the extent that equity-based compensation signals that firms are clearly not buying labor in a spot market, do you think that we ought to include measures of labor compensation in our measures of investment, and potentially see that if it helps reverse the documented fall in investment over time?
Okay, yeah, and those are things we'll talk about after the break. So there's some work by Cruzette and Eberly and others on, you know, the kind of investment gap and the closing the investment gap with investment in intangible capital. I'm going to show you some data from 10Ks, a couple of 10Ks that shows you this equity-based compensation showing up in SG&A. And so I don't think we've, you know, done enough yet on thinking about how much of compensation that's showing up in SG&A can be wage or equity, you know, is investment in intangible capital, you know, versus payment for marginal products. So that question affects, again, this earlier question of what fraction of SG&A to include as investment versus, you know, payment for marginal product. But it's interesting that you're pointing out, you know, kind of the link between these two things. Yeah.
Yeah, there is another question from Yikan Shen about the incentive behind the equity-based compensation. Do you think it's more about the firms that prefer to put more funding into growth, or it's more about the workers that are willing to take the risk for more gain in the future? Do we have evidence for that?
Yeah. Well, I think the paper by Sun and Shalon does give evidence about investment in intangibles and equity-based compensation, so that, you know, when you kind of defer compensation to workers and you do more spending on R&D and advertising and higher SG&A and things like that. You know, kind of the risk preferences of employees, that's another interesting question. It's something that I find, you know, many people find, you know, puzzling, is sort of, you know, what are the returns to investments in your own firm? Why do you have undiversified investments? You know, entrepreneurship has questionably, you know, it's questionable whether those returns have a positive and positive net present value. So I haven't, you know, I don't have the answer for the risk preferences of the employee, but I do think, kind of related to the earlier question that was asked, you know, it harks back to this background risk question. You know, we have this empirical fact that these high skilled laborers are compensated more with own firm equity, and that certainly does put substantial, you know, own firm risk on them, and they already have their labor income tied to that firm. So I think there, you know, just like there is with CEO risk preferences, kind of classic work by Almendia and Tate, there are interesting questions about the worker preferences. You know, are these high skilled laborers very different from CEOs? Are they more like CEOs than other workers, or are they kind of like standard workers that, you know, wish they would just get money this year, but, you know, got to take the equity-based pay that keeps them sticking around?
That's it. No more questions.
Okay, great. Well, that's perfect timing. We will take a 20-minute break, just so everyone can stretch their legs and get some coffee, whatever. So I'm going to go off Eastern time, so that will have us meeting back at 1:50. And I look forward to seeing you guys then.
Perfect. Thank you, Andrea. And for everybody following on Facebook, I will pause it now, and we'll restart once we're back on. So see everybody in 20 minutes or so. Thanks again.
Thanks, Dick. Thanks, Maria.
Okay.
Okay, great. So Thanks everyone for coming back, and thank you for all of your questions so far. I want to encourage you to, ask away. I definitely left plenty of time for questions, and I think all of the questions that we've had so far have been, really insightful, and having that conversation I think is so helpful for research, and it's very important, especially now. So I wanted to thank you in advance for more great questions and chatting with me about a topic that I'm really passionate about. Okay, so let's keep going. I guess one last thing I'm going to say about compensation. I have this paper that I felt like had a question that I left unanswered, and I always wanted to work on it and didn't have time, so I guess I thought I'd throw it out there. This is a paper on CEO, it's called CEO Turnover in a Competitive Assignment Framework, and it addresses this kind of older puzzle in the CEO compensation literature and CEO turnover literature that, when you have when you can, base a manager's performance on their performance relative to peers, and you can filter out industry shocks, why do we still see that absolute performance matters for turnover? And so Cami and I had this idea that the match between a CEO and its firm was based on both matching along a firm-specific dimension and then along a general skill dimension, sort of in the more traditional assortative matching framework that's been used to think about CEO compensation. But we thought about industry shocks in a different way. And it's kind of related to some of the other topics we'll talk about today. So we thought about industry shocks actually coming from a change in the need for a certain type of manager. So when an industry or a firm's in a growth phase, they need a manager who's really good at growth and acquisitions or raising finance, et cetera. But at some point, the firm may instead need someone who's better at cost cutting and increasing efficiency, that kind of thing. So the industry shock was really a shock to the type of manager that's needed. And as the match quality depreciated from that shock arriving, the whole industry performance would be low because of the deterioration in the match quality. But at the same time, you would see turnover for that absolute performance decline. And in particular, that performance or that turnover would be more likely for managers that had a lower skill because it would be less costly to lose them relative to the cost of losing the firm specific skills. So one of the things that made me think about is that managers do have different types of the famous work by Antoinette and co-authors on managing with style, Antoinette Shore. And maybe we should be pricing managers as hedonic goods to understand trends in CEO pay across industry or over time and that kind of thing. So I thought thinking of managers as hedonic goods might be kind of an interesting exercise. Okay, so now I'm going to move to some slightly different topics, some of the ones that we previewed when we first started. The first is concentrated ownership and background risk. So the unique ownership structure of intangible and human capital can lead to concentrated ownership, equity-based compensation, and background risk. The effect of background risk on asset pricing and risk sharing goes back to Heaton and Lucas in the 90s, Talmer in the 90s as well. Some recent work by Garliano, Kogan, and Panagias, and Kogan, Papanicolaou, and Stoffman, where both of these papers kind of attack the value premium by saying, growth stocks earn a low return because they are a hedge against innovation or displacement risk, or they allow investors to get exposure to cash flows that that are correlated with the possibility either that they're displaced or something, or lose their job, or some new technologies that are going to adversely affect them. So the basic idea in both of these papers is that growth stocks are a hedge against some sort of displacement or innovation risk. And that, you know, kind of seems pretty closely related to the value of intangible capital. And I'll come back to that at the very end. I also wanted to mention this paper by Haddad, Concentrated Ownership and Equilibrium Asset Prices, that thinks, you know, carefully about widespread concentrated ownership and equilibrium frameworks. I think it's a useful workhorse for thinking about these issues. But it kind of, when I read this literature and I think about its relation to intangible capital, I'm left with a question. So we know that high organization capital firms, as measured by high accumulated SG&A expenses, have higher expected returns. That's the stylized fact. And so whatever, you know, models we have to be consistent with that. We have, you know, one model on the table, but we have to think about, you know, the aspects of the asset pricing problem that we, you know, maybe were not included in the model, and how do we reconcile those? So if ownership is concentrated, then maybe, you know, high expected returns make sense, because you have to compensate people for the fact that their background risk is correlated with the firm risk. But at the same time, you know, for non-key talent, you know, maybe those firms are a hedge, because, you know, if high skilled labor or key talent is sort of, you know, displacing regular workers, then it should be a hedge for those workers. So I don't know if the answer is that, you know, only the top end of the income and wealth distribution own stocks. But I think, you know, we haven't really just put this question to task, which is what kind of background risk does organization capital place on the people who are compensated with firm level stock, and how does that affect expected returns? Because we really, you know, in the asset pricing paper that I worked on, we really thought about it from a you know, kind of not a representative investor framework. There was systematic shocks that decreased the cash flows from those firms when reallocation took place. So we didn't think about the fact that, you know, some of the owners of those firms are actually the people who are compensated. Okay. So these topics are a little bit shorter, so let me do a couple of them. And then I'll pause again for questions. So please, you know, do keep the questions coming, and we'll maybe do one more section and come back to this. Okay, so I want to talk about production-based approaches because, you know, the measurement challenge is so large, and I think putting some structure to the problem, you know, may really help us. So I want to remind ourselves about this, you know, really nice framework proposed by Cochrane in his two papers in the early 90s, one of them which was entitled Production-Based Asset Pricing and the Link Between Stock Returns and Economic Fluctuations. Some of this framework was exploited in the next two papers, Intangible Risk by Hansen, Heaton, and Lee in the 2005 NBER volume on intangible capital, and the newer paper, Decomposing Firm Value by Salamao, and Vittorino. But you know, I think there's still room to exploit this production-based asset pricing, because we, you know, maybe we do observe something about the investment in intangible capital, and we certainly do observe something about stock returns. But it's, you know, of course, a bit more complicated when you have two types of capital, and one type of capital might be owned by workers, et cetera. And then I'm gonna briefly, you know, suggest future work on intangible capital measurement using a framework that would be analogous to this priceless consumption paper by Bello and D'Angelo. Okay, so let me talk a little bit about this paper, Decomposing Firm Value, because I find it, I like the neoclassical structure of it. I think the findings are interesting. So let me talk a little bit about the methodology, the findings, and maybe some possible extensions. So this, you know, it's a very standard neoclassical framework where a firm is maximizing value. They write down a fairly straightforward maximization problem, and they have homogeneity that allows them to express the value of the firm on the left-hand side as the shadow value of each type of capital that the firm has times the stock of that capital. And then, equations 8 through 11, there are just giving those shadow values. From this like sort of very standard neoclassical framework, where the main difference between standard models and this model is that now they don't just have physical capital, and they don't just have kind of entirely flexible labor. They have labor adjustment costs. That means that the value of labor inside the firm can be just, different than its rehirable value. It has knowledge capital and it has brand capital in it. So we've got these 4 types of capital. They each have their own shadow value. The total value of the firm is going to be the shadow prices times the stocks. And what they're interested in is explaining firms' market values with the contributions of these different types of capital. So knowledge capital, sort of, somewhat sticky labor, P is physical capital, labor, knowledge capital, and brand value. So here are their estimation equations, and they have, shadow values on the left, and then on the, shadow prices on the left given by these expressions on the right. And what they're looking to estimate here and what they're going to be matching is, using market values are these adjustment cost parameters, theta. And what I want to point out is that, there's no reason that we couldn't, instead of estimating those investment adjustment costs, we couldn't, estimate the percent of spending that is investment, where here it's just taken to be 100%. But like we said, what we really want to know when we're looking at expenses and using those to along with the perpetual inventory method to measure investment is what fraction of that spending is actually investment. So we could put another parameter, and I'm going to call it gamma, and that's kind of, taken from a paper we'll talk about in a minute, the Ewens, Peters, and Taylor paper. But we could estimate that fraction, and we could maybe calibrate these investment adjustment costs, and we could use this framework to come up with estimates of what this fraction of expense spending is that is actually investments in capital stocks. Okay, so that's just an idea of how we could use this framework. I think that, I would certainly be very interested in seeing those results, especially how the gammas would vary across industries. Another thing I want to point out here is that there's no organization capital in this model. So, kind of one of the things we talked about earlier is maybe that's, that makes it easier because maybe patents can be owned and will show up in market value. Maybe brands can also be traded and they would show up in market value. So abstracting from organization capital abstracts from this sharing rule that'll affect the fraction of organization capital that shows up in market value. But at the same time, I think that organization capital has been shown to be such an important part of the intangible capital stock, that it's a little unfortunate that it is missing here. But, still, this is a very sort of, first order exercise as it is. So, kind of don't want to nitpick. I think these results here that they find for the decomposition are interesting, some kind of intuitive. So what we have here are the fractions of firm values that come from these different capital stocks. And this is the physical capital. This is the labor. This is the knowledge capital. And this is the brand capital. So we have low skill on the left and high skill on the right. And, interestingly, in the low skill industries, the brand seems to be a more important part of firm value. Physical capital also seems to be a more important important part of firm value. I think that's pretty intuitive. Labor is a lower fraction of firm value, sort of having an installed base of labor. And then knowledge capital is a much higher fraction of firm value for the firms on the right-hand side. And so I think that's, very intuitive. The cross-section decomposition makes sense. We see that the big increase in the fraction of firm value that's coming from knowledge capital and brand value, from knowledge capital, is mainly in the high skill industries. So just to give you guys an idea of what kind of results that these guys get out of their nice framework. Okay, so this is, I guess, kind of highlighting a couple of things. This framework is kind of related in a way to the Cochrane production-based asset pricing methodology, but I think there's a way of taking that method even more directly to think about intangible capital. And then there's also this extension I mentioned on just focusing on different parameters of estimation from a framework that could be very closely related to this one. I'm going to do the same kind of thing with this paper, Priceless Consumption. This is a paper by Bello and Donangelo, and this is using consumption shares to try to measure consumption, that is priceless, that we don't buy. So things that we don't observe, monetary transactions for. And so I don't want to go into the details because it's, on the consumption side. But what I wanted to say is, if we learn something about the shape of the production function, and we learn about the complementarity or substitutability between the different types of capital, those kinds of Euler equations in the production function also give us shares. So like in the Human Capitalist paper with Minnie and Antonio, we have those shares, and we may be able to use those shares out of the total along with some investment spending data to again uncover some of the parameters that describe the link between expenditures and investment on intangibles, which I think is one of our key questions as we go forward with measurement of intangible capital. Okay, so let me talk about that measurement, and then I'll take a break for questions. So I'll talk about two papers. The first is Depreciation of Business R&D Capital by Lee and Hall, and the second is Measuring Intangible Capital with Market Prices by Ewens, Peter, and Wang. So these papers are both asking, well, in some sense, in one case, the same question. So we know that depreciation rates for intangible capital and the fraction of the fraction of expenses that are investment expenditures probably varying across industries. And those, as we saw when we looked at the perpetual inventory method, those depreciation rates and fraction of expenses that are investments probably vary across industries. So the first paper is really only thinking about how do we depreciate R&D spending, and the second paper is thinking about those depreciation rates for both R&D and organization capital and the fraction of expenses that are investment in intangible capital. So this is a picture from the papers and proceedings AER paper that I have with Dimitris, and I just wanted to put it up because we have this very simple industry classification where we use the Fama French 5 industry classification, just I think a slight refinement to deal with some of the other industries. But it's, everything is relative to its 1975 value here. And the reason we do everything relative to 1975, again, is to get away from this fact that we don't know what the fraction of SG&A expenses that are investment is. So, scaling by either within industry or by, some normalized point in time in the industry, we were hoping will alleviate any problems from that, but we definitely, acknowledge that it's an issue. So one of the ways we can see that it's probably an issue is that it's just, we have these very different patterns of the importance of organization to physical capital across industries and over time. So we have some industries like high tech in the green, finance in that kind of hollow blue line, and health where we've really seen organization to physical capital grow in importance to where it's now 50% larger. But then we have industries like consumer and manufacturing, and in particular manufacturing, where it looks actually like organization capital relative to physical capital has declined over time. So we talked a little bit about some of the differences, maybe, finance was an interesting place to look for the sharing rule with key labor talent to have an important impact on firm value, for example. So we know there are these important industry differences. So one question is, this is even assuming that the same fraction of SG&A expenditures is investment in organization capital across industries. And here we use the 30% that Shaolan and Peters and Taylor and others have used. So we know that there are probably these important differences across industries. We have limited data from 10Ks on the breakdown in selling and general administrative expense. So it happened to turn out that I was looking for a simple firm to use in my corporate finance class. And Edward Kim, who's a very talented grad student of ours at UCLA, uncovered this firm, Sanderson Farms, where they actually have a schedule, I believe it's Schedule 7, that lays out exactly what is in their selling and general administrative expense. So this is kind of an interesting find. A lot of times what you'll see is the 10K will talk about where increases or decreases in selling and general administrative expense come from. And there may be a way of using those changes and the levels to back out something about the contributors to SG&A. So I think that would be very interesting. But this is one, I think we haven't found systematically, many firms that have this. In fact, we looked through all the, I think, some of the top 50 firms by industry and didn't find a whole lot of this, but it's kind of nice to see what exactly is in here and how much it contributes. So you can see things like that you would think contribute to intangible capital, like advertising expense, trainee expense, startup expense for the Tyler Texas complex, probably, some of that is, getting the team together, et cetera. So I did this just very quick and dirty, is how much of it is investment in organization capital. So, this is not anything hard and fast. This is, very much hand waving and guesstimating. So I put those three as one, but now we have these tough things like stock compensation expense. So I put a half, all other SG&A expenses 0, employee stock option ownership plan, put a half, depreciation expense 0. That's why that Sanderson Farms, we needed this, is because we were trying to find the depreciation showed up here. So that's something to be aware of. The championship expense kind of sounds like advertising. So we gave it a 1, administrative salary 0, legal expense 0, third party sales commission 1. So that could be 1 or 0.5. So a couple things come up. One is, interestingly, if you come up with the total investment in organization capital relative to SG&A, it does turn out to be 30%. I didn't plan that ahead of time, it just kind of came out like that. So 30% is the number that people are kind of using. But now you kind of see, if we had to make assumptions, couple of things come out. Some are, that some of these are clearly zeros, like legal expense, for example. But these big items like stock compensation expense and employee stock ownership plan, those are fairly big items. And how much of that is investment in organization capital? How much is just payment for marginal product? Is it possible that it's both? you know, I think these interlinked questions about compensation and investment in organization capital, you know, are first order importance. So here's another example. That's a manufacturing food manufacturing industry, or consumer industry, I guess is how it would get classified. Here's a high-tech firm. This is Adobe, and you know, it has a much broader breakdown of its SG&A expenses. So research and development, but that includes incentive compensation, base compensation and related benefits associated with headcount, professional and consulting fees, various individually insignificant items, sales and marketing. So it has marketing spending with campaigns, blah, blah, blah. Also base compensation related benefits associated with headcount, incentive compensation, cash and stock-based, professional and consulting fees, amortization of contract acquisition costs, and various individually insignificant items. Then we have the general and administrative professional consulting fees, facilities and telecom, incentive compensation, cash and stock-based, base compensation and related benefits associated with headcount, software licenses, and various individually insignificant items. So now if we had to, you know, if we had to make a choice, we might say that the general administrative expense was not investment in organization capital, but we might say that, you know, a large fraction of research and development and sales and marketing would be investment in some sort of intangible capital. Could be organization capital, knowledge capital, brand capital. But you notice that we know from Sanderson Farms, and we expect it's probably true for Adobe too, a large fraction of those research and development and sales and marketing expenses are compensation expenses. So again, we have this really important question of how do we think of compensation? How much of it is investment in intangible capital and how much of it is payment for marginal product? But okay, so those are the hard questions. The easy thing would be, you know, to systematically go through these 10Ks and try to see how much we can glean about the breakdown within SG&A, because we really are operating, you know, with a low degree of certainty. I think lower than we need to these days. You know, when Demetrius and I looked through 10Ks, we did it by hand, but there are much faster machine ways of doing that now, although it's always hard because you're dealing with a section of the 10K that isn't standardized. Okay, so let me get into these two papers. So the first is the Lee and Hall paper, the depreciation of business R&D capital. So really focused only on the depreciation of business capital. And, you know, they're going to start also from a fairly standard neoclassical framework, but then, you know, they're going to need some assumptions to get their estimation off the ground too. So they're going to have a firm that chooses R&D investment to maximize the net present value of the expected return to R&D investment. So the R is the expenditure, and then the quantity in the brackets is the sum of the discounted. This is sales. This is the stock of R&D expenditures, and then the delta is the depreciation rate. And then they have this D here, which is a gestation lag. So it takes some time between investing in R&D and having this stock come out. So the way that they deal with the fact that the prices of R&D assets are unobservable is they take the expenditures on R&D and they convert that into a stock of essentially knowledge capital or R&D assets using this function I of omega. And what I of omega is basically doing is you get more R&D assets the more you spend on R&D, but there's some, you know, cost that may vary over time that, you know, kind of decreases the amount of actual R&D assets you get out of $1 that you spent on R&D. Okay, so from that, they can write the profits according to the equation 4 at the top of the slide. And then assuming profit maximization, the optimal choice of R&D spending implies this first order condition. And then that's what they're going to take to the data by adding a disturbance term. So you can see there, oh, this G just, is, just so you know what it is that theta, that sort of translation rate between dollars spent and how much R&D that you get out, can vary over time. And it actually is growing at this constant rate, capital G there, where sales are growing. This is sales growth rate, and this is the theta growth rate. So now what they're interested in doing then is estimating this delta, the depreciation rate. And they're going to do that using this equation here. And what they find is here on this slide, and I mean, one of the things I thought was pretty amazing is, they're estimating these things given their assumptions pretty precisely, because, these standard errors are fairly small given the estimates. But there's a lot of variation in the depreciation rates here, first of all. So things like, computer system design have very high depreciation rates, and then some of the other ones like pharmaceutical has a low depreciation rate. Then one of the things I want to highlight here is there's an assumption about the ex ante rate of return that's important for their estimation. So there's a trade-off in their estimation methodology between the rate of return that they assume ex ante and the depreciation rate that's going to come out of their estimation. Because if they assume a high rate of return and the actual return turns out to be low, then that's just going to imply that they had a lot of depreciation. And so their estimates turn out to be very sensitive to this ex ante rate of return assumption that I've highlighted down here in the bottom at 8.9%. So one of the things that they do for the industries that ended up having fairly negative returns, and so, fairly high estimated depreciation rates, is they did a sensitivity analysis and did those two industries with this rate of return of just 1%. So they did that for aerospace and for motor vehicles, bodies, trailers, and parts. And you can see that that just has, an enormous effect on the estimated depreciation rates. So for aerospace, with the rate of return assumption of about 9%, the depreciation rate is 33%. But if you have a much lower rate of return ex ante assumption, you're getting depreciation rates of only 6%. And for the motor vehicles, you get a depreciation rate of 73% with this high return assumption, and 12% with the low return assumption. So this is, you get a precise estimate given your assumptions, but here are our estimates are sensitive to the assumptions. And more than a critique of this paper, because I like this paper very much, I just want, especially because of how open they are about, what is driving their results. I think that's an excellent way to do research. It shows you that there's room for future research here. I mean, this is a very important question, and we have some intuitive estimates here, but ultimately when we want to measure stocks of unobservable types of capital, that depreciation rate is going to, affect our estimates. And so we need something to use. And this is probably the state of the art that we have right now. So there's another paper that focuses on estimating two of the parameters in the perpetual inventory method for R&D assets and for organization capital assets. And that is this very nice recent paper by Ewens, Peter, and Wang in 2019. They are going to be interested in estimating the delta G, which is the R&D depreciation rate, and the gamma S, which is the fraction of S, G, and A, which is investment in org capital. And And they're going to use differences between market and book to do this. So that is closely related to the strategy in Hansen, Heaton, and Lee, the intangible risk paper in that NBER volume. So I would, and I don't think that connection is made in this paper. So I would encourage anyone, you know, kind of working on this to go back and look at that paper. And in addition to some of the more, in addition to the Lee and Hall paper and the production-based asset pricing approaches we've talked about. But they're going to use two broad strategies of using market to book ratios to try to estimate these parameters that describe the evolution of intangible assets. The first is just use all CompuStat firms' market values, subtracting tangible assets, so something like book value of assets or PP&E, something like that. Or they're going to use either acquired or bankrupt firms where you get some estimates of intangible assets. One is identifiable intangible assets that happens with an acquisition, and the other is goodwill, which is basically when a firm buys another firm, if it pays more than the book value of assets, then there is going to need to be some assets on the acquiring side that make up for the difference between the book value of the target firm and you know, what the acquirer actually paid, so that their T accounts, their assets still equal their liabilities. And those two categories for making the T accounts balance will be identifiable intangible assets, which is where the accountants think that they can, you know, account for the price paid for the target with some identifiable brand value or systems value or knowledge capital. And then there's this other category of goodwill, which is, you know, a little more amorphous, and, you know, there's a fairly sizable accounting literature, which is worth looking at to assess, you know, what you think goodwill is actually measuring. So to these authors' credits, they do some adjustments that account for the fact that there might be synergies in acquisitions, that acquirers might overpay, et cetera. So they do their best to try to get those you know, to adjust those recorded intangible assets of goodwill and identifiable intangible assets to be as close to clean as they can get. And then what they're going to do with either of these two methods is to estimate this equation labeled 12 here. And, you know, here we've got our parameters that we're interested in: the depreciation rate on R&D capital and the fraction of SG&A spending, which is investment in organization capital. And here they're assuming a depreciation rate of 0.2. It's just kind of a trade-off between the estimating the depreciation rate and estimating this rate of expenditures that is investment. You can't really get both because they're, you know, increasing one is going to imply that the other needs to be higher. So they're going to go after these two parameters, which I think are, you know, probably the two, maybe the two more interesting ones, although the depreciation rate for organization capital is also interesting. We'll take, you know, what we can get. And then they're going to use on the left-hand side the price of intangible assets that they get from these two methodologies above, either sort of market minus book, or, you know, kind of market relative to these acquisitions or bankruptcy intangibles. And so when we look at this estimation equation, intuitively, what is going to have to drive gamma S and gamma G? Well, the higher sort of this price of intangible is, the price coming from you know, kind of market relative to book of acquisitions that's going to be captured in goodwill, or, you know, market minus book in CompuStat, it's going to be, you know, the higher the market value of intangibles is, the higher the market to book ratio, the kind of, you know, more goodwill there is, or more even identifiable intangible assets, which I think is the really, you know, neat part about this paper. The higher the value of those market values of intangibles, the lower the depreciation rate on R&D, and the higher the fraction of expense spending that is investment in intangibles. And so I think this is you know, a very complementary method to the one used by Lee and Hall, in that Lee and Hall is not using any market values and relying entirely on kind of neoclassical capital theory type of things. And while this paper is using the information in market values to estimate these investment and depreciation parameters. So I see these methods as very complementary, both with their kind of own advantages. When we look at the results from this estimation methodology, and they actually do, you know, they have their two basic methods of using all CompuStat versus using just the acquisitions and exits. Here, let me pause for one moment while I deal with some external noise. Okay, thanks for bearing with me. So if we look just at this column 7 and 8, which is their preferred estimation method, and we focus, because we kind of talked about delta G when we were talking about Lee and Hall, if we focus on column 7, I think what's very intuitive and comforting about the results of this estimation is if we look at the fraction of SG&A, which is spending on organization capital, in consumer and manufacturing, you know, it's lower, say 38 or 24%, where in high tech and health, it's higher, say 60% or 62%. So I think that's, you know, maybe intuitive. It's kind of the difference between Adobe and Sanderson Farms. More of Adobe's SG&A was maybe on organization capital than Sanderson Farms. And I want to note that any differences in the fraction of SG&A spending that is investment in intangibles will magnify differences across industries, because we already know that high tech, finance, and health have higher SG&A expenditures. So if the rate of applying those expenditures as investment in intangible capitals is also higher, that will magnify the difference across industries. Okay, so I think this is a very nice framework using some novel data to take to this question. In particular, this idea of using the recorded intangibles from acquisitions, I think is really an interesting observation. I think for both of these papers, you know, it's such an important question. We can go further to figure out what these depreciation rates and investment rates should be. And some questions we might ask ourselves would be, you know, what do we think is observable about intangibles? Do we think we see market values, or are market values corrupted by the fact that the ownership of intangible assets, you know, may not be fully captured by the value of debt and equity claims? Is it book values that we get out of accumulating investment expenditures, that then we have this uncertainty about depreciation rates, initial values, what fraction of expenditures is actual investment? And then, you know, do we want to use real values in you know, capital theoretic type of models, or do we want to use finance models? And of course, I think the answer is, you know, neither method dominates the other, and the more we can integrate these two, you know, the finance side and the capital theoretic side together, kind of the better answers we will get. So I think future work can really work towards merging these complementary approaches. Okay, so let me stop there and take some questions.
Yeah, so one question is from Vrinda Mittal. Will it be fair to say that knowledge capital captures some part of organizational capital in the form of talent owned?
Can you repeat it? Sorry.
Will it be fair to say that knowledge capital captures some part of organizational capital in the form of talent owned?
Talent, you mean that that our knowledge capital is sort of is a type of intangible capital that I would think of as organization capital, because it's partly talent owned. Yeah, so is that the question, I guess?
I guess, yeah.
Okay, yeah. Yeah, I think that it's, we talked about whether patents could be, this is getting to a question we're going to talk about at the end, which is the capital structure of intangibles. And, you know, what can be owned by the marketplace, what must be owned by the key talent that produces it. To me, R&D or knowledge capital is, you know, is a mix of both stuff that outsiders can own and stuff owned by key talent. When we saw the SG&A breakdown for Adobe within the R&D expenditures, you saw that a large part of that is compensation, and that's because you know, a lot of research is embedded, you know, in the people that do it. We know that because we don't communicate everything that we learn over time, unfortunately, you know, to the world at large. It would just be information overload. And sometimes we don't know what's going to be important out of what we've learned until later on. And some of the important stuff then will get patented or published. And then that is more tradable and more able to support external claim holders. So the answer, I guess, to the question is yes, with that sort of context around it.
There is another question from Junie Liao. What does intangible capital mean for our current knowledge of firms' financial frictions? How collateralizable is intangible capital?
Yes, that's a very interesting question, and I think there's a paper by, and I might be incorrect about the author, called by Henji Ai and co-authors, called The Collateralizability Premium. So this is sort of, you know, this is related to people who think about collateral and capital structure, intangibility and capital structure and value. Sorry, can you repeat the exact question again? Sorry.
Yeah, so what does intangible capital mean for our current knowledge of firms' financial frictions, and how collateralizable is intangible capital?
Yeah, so I think one of the things that you see that's very interesting is it seems like intangible capital should be very hard to collateralize and very hard to issue external claims to, but we seem to financially innovate and be able to finance intangible capital. And then the more we financially innovate and finance that intangible capital, sort of the more we can grow intangible capital, the more we can invest in it. So I think that there's this really, you know, on average, probably productive or, you know, in terms of increasing firm value, interplay between financial innovation in terms of, you know, being able to codify or patent or collateralize intangible capital, our ability to finance it, and the amount of investment that we can do in it. That, you know, that's also sort of, you know, again, linking that with compensation and to kind of the growth in intangibles over time. You know, I think there would be some very interesting research to do there. Yeah, it's a good point.
That's it.
Okay. All right. Thank you for those questions. We just have a couple more sections, and then I'll make sure to leave some time for questions at the end. Okay, so let's talk a little bit about investment in Q theory. So I'm going to talk through these papers, Intangible Capital and the Investment Q relation, Rents and Intangible Capital, a Q plus framework, and why did the Q theory of investment start working? Because I think, you know, these papers have speak to each other in interesting ways. Okay, so this is this very nice paper called Intangible Q by Peters and Taylor in 2017. So they do this very, you know, intuitive application of capitalizing intangible capital, and they construct a total Q measure where we have the market value of the firm relative to the book value of intangibles that is constructed using the perpetual inventory method. And they were kind enough to post their series on Words. And the results that they find using this total Q measure, I think are really intriguing. So I'm gonna focus on this one figure from their paper where they're plotting Tobin's Q and investment. And Tobin's Q is the blue line, investment is the green dashed line. And then they do, on the top left panel, they're showing standard Q and standard investment. And so that's just, you know, does Hayashi hold? Do we see firms investing more when Tobin's Q is higher? And also if marginal and average Q are equal and there's no noise, then that's sort of, you know, Q should explain most of what we see for investment. And what you can see here is Q doesn't really work very well for standard investment. The eyeball correlation here is fairly low in this top left panel. But what's, you know, maybe more interesting, and this is something that's going to be the focus of the Andrea Mann and Moyan paper, is that it sort of seems to start working better later in the sample. And that's sort of, in my mind, it's kind of a puzzle, very interesting puzzle to think about, because intangible capital, you know, you would think of as more important in the later sample. But here we see actually Q kind of works fairly okay, not including intangible capital in the later part of the sample. So the next panel on the right, I'm going to do this one next, is the relationship between total Q and physical investment. And you can see that that picture looks kind of similar to the top left panel. So when Tobin's Q sort of starts working better to predict investment in the later sample, it's because it's predicting investment in physical capital. And that's the total Q now, including intangible capital. So, you know, again, I think that this is in it, you know, trying to understand why total Q is working better for predicting physical capital investment later in the sample is interesting. It's related to things we talked about in terms of the complementarity, perhaps, between physical capital and intangible capital. But it's certainly interesting that when we look at you know, total Q and intangible investment, and then total Q and total investment, that just, you know, casually, it sort of looks like the reason that total Q does better at predicting investment is not because it's predicting, you know, total investment better, at least later in the sample. It's really that it's predicting physical capital investment better. But you know, that said, sort of, you know, these two lines are closer together certainly than maybe these two lines down here. So in any case, what I want to say here, and there are these couple of other papers that take up this topic again, is that, you know, this paper really presents some intriguing findings, and once we refine the measure of Q to include the importance of intangibles, but there's definitely, you know, sort of more details to study as follow-on work. So the paper by Andrea Mann and Moyan, you know, exactly takes up this fact that the stylized fact has changed. So one of the, you know, classic puzzles in corporate finance is, you know, that we see an effect of cash flow on investment. A lot of times that effect is larger than the fraction of investment that is explained by Tobin's Q. And we sort of take it as a given that Q sort of doesn't really work that well to explain investment, and we have financial frictions and rents and different reasons why marginal and average Q might be different, and measurement error, and sort of why these regressions don't work as well as we think they should. These guys point out actually that the regression does start to work fairly well in the latter half of the sample. And in particular, they point out that the R squared really changes. The R squared in a regression of the investment rate on Tobin's Q has really increased from, you know, 7% to 70%. So this is just a really big increase. And then, you know, these guys are really good at, understanding mechanically and econometrically the drivers of this change in R squared. And so there's an extremely eloquent, clear discussion of what's driving this in the paper. And it is this increased dispersion in Tobin's Q. So it is the, the fact that Tobin's Q becomes more variable that leads to the ability of Tobin's Q to explain more of the variation in investment. So this is the mechanics of how this R squared is being driven higher in the second half of the sample. And then the paper has a theory that involves learning that explains why this increase in dispersion in Q occurred and drives this change in the relationship between investment and Tobin's Q. So I think this is certainly an interesting fact. The explanation of how the fact works is super clear and intriguing. The theory fits the data well. At the same time, I think there are probably lots of ways to understand what's driving this dispersion in Q, and why this investment Q relation might be changing, and the way it's changing for intangible investment versus tangible investment. It just seems like a very interesting set of facts to be thinking about. So this next paper is fairly closely related to both of these papers, in particular the Peters and Taylor paper. So for those of you familiar with Jan Eberle's work and her work with Andy Abel, if you want to study investment capital theory, you just have to read their beautiful papers on the topic. And of course, Eberle and Cruzet come up with this very clean theoretical framework to try to dig into what we should expect to see about Q and investment when we have two types of capital. And not only in their framework do they have two types of capital, but they also have the potential for markups and rents. And so in their framework, one of the points that they make is once you have two types of capital and in any kind of market power or markups, you no longer can just add the two types of capital together in order to construct the book value for Tobin's Q. And so here they give their the representation for Q that you get when you have two types of capital and also potentially rents from that capital. And you can see three reasons that marginal and average Q would not be equal. And that would, of course, cause this. The empirics are done with average Q, and so that would cause this investment Q regression to break down. The first is that, here's Q as one in sort of the classic Hayashi framework, but now you've got the effect of the intangibles, but you don't just have the effect of intangibles, you have the effect of rents or markups, and then you have the interaction of rents or markups and intangible capital. So, I think it kind of a very interesting modern way of thinking about the effects of both intangible capital and markups on Tobin's Q. So we're going to talk a little bit about the implications for this paper in aggregate data. So they're going to use their theoretical framework. They're actually not going to need to do any estimation because their theoretical framework is going to allow them to directly measure all of the inputs to this equation. And the inputs are just given by these next three lines. So they have the markups given by return on assets, normalized by the user costs of the two types of capital. And then 1 over R minus G, they show in their in their framework is equal to the price dividend ratio. So if we look at the bottom at these user costs, the interest rate plus the depreciation rate, you know, the paper shows that those are equal to the dividend price ratio. They're going to then use that those two user costs along with the price dividend ratio, the return on assets, et cetera, to decompose the difference in Q from 1 into these three components: the part from intangible capital, the part from rents, and the part from the interaction between intangible capital and rents. And one of the things I want to point out while we're on this slide is, you know, because the rents terms, the two rents terms, are going to depend on the dividend price ratio, you know, you can see that this, this empirical method is going to, you know, have the fraction that is contributed by rents and intangible capital varying with the price dividend ratio, because, you know, those things are in the denominator. Okay, so let me make sure I leave enough time for questions. Yeah, so let me just show the results from this estimation. The intangibles direct effect is in the kind of medium blue. The market power times physical capital is in the dark blue, and then the market power times intangibles is in the light blue. And you know, it would be interesting to see some sensitivity analysis around this. I think the framework is you know, really clear, really useful. I guess because of my, you know, maybe because of my training, I always have to question, you know, this role of imperfect competition and market power. I know there's a lot of evidence on rising market concentration, rising market power. Some of that evidence we said on markups is really, you know, based on revenues minus COGS. And when SG&A becomes a more important part of the total cost bucket, that markup will be said, you know, estimated to be increasing. So I'm just going to question a little bit, you know, the magnitude of the importance of market power in driving the deviation of Q from 1 here. And that is just to say that in this paper that we talked about earlier, that decomposes firm value in a totally competitive framework, they get a very high fit, at least in the cross section, of their, you know, prediction for firm value relative to what's observed in the data. So I guess I'm just kind of throwing this out there that, you know, more work can also be done on the relationship between intangibles, markups, and market power. What I really love about this paper is it points out these important interactions, that when you have intangibles, you're going to get different answers about markups. Okay, so I want to allow a few minutes for questions. So let me actually just mention the capital structure question, and I'll very briefly mention these two papers. This paper by Filato, Kadir-Zanova, Sim, and Sterry basically just documents this really striking fact that we've had this increase in cash that people have been talking about over time. At the same time, we've had intangible to net assets increase. And what that's implied is that net leverage has come down. So this makes the first important link between cash and intangible assets, and sort of the way we finance intangible assets might be much more with internal cash than with external debt. The Sun and Xiaolan paper that I've mentioned a few times also makes this point. I'll just, you know, point out that in the regressions, for example, for CapEx, you see CapEx and debt be closely related, but then R&D actually, you know, depends negatively on equity issuance, maybe even negatively on debt issuance, but it's very positively related to cash flow, to equity-based compensation, and to Q. So just another really nice take on introducing us to the idea that the way intangibles are financed is different from the way physical capital is financed. And Maria, let me just see if I can answer one or two questions before we have to break up.
Yeah, there is one question. So the question is about intangible investment specific shocks. There has been research showing the relationship between intangible investment specific shocks and economic growth. So the question is more about how it's related to macroeconomics. What is the impact on macro, and what the shock is?
Okay, is the question about different investment specific shocks for intangible assets and physical capital?
I am not entirely sure. Maybe you, Cheng, could ask the question better than I can.
So my question is, there is a previous research about this tangible investment specific shock and the economic growth, and how would you think about this intangible investment specific shock and the economic growth on other macroeconomics impacts? And how would you interpret this intangible investment specific shock?
Yeah, that's very interesting. So the IST shock for physical capital, sort of like we think capital goods prices have been coming down, and you know, people have thought about the effect of that on business cycles, on asset prices. Super interesting. So if you think about the price of intangible assets that are tied to labor inputs, you know, they may actually have been going up over time. So we have this, you know, maybe some improvements in efficiency, but some of the inputs, certainly the cost of high skilled labor may have increased over time. And so, you know, yeah, I haven't seen any research on that question. I think it's very interesting having like you need sort of like they have for physical capital price deflator series. I have not seen that for intangible capital. So you have to build on all this literature we've been talking about on you know, on trying to estimate accurately the stock and the value and the prices. But it sounds like a very important question. It's really intriguing.
Thank you.
No, thank you. I know.
Sorry, I was muted. Yeah, no more questions, I think.
Okay, perfect. I'm sorry for taking up, you know, the last few minutes and not leaving more time for questions. You know, please feel free to get in touch with any ideas that you have. I will try to get to them. And I really appreciate everyone's time in joining today, and I'm loved hearing everybody's ideas and questions. It's really exciting to be talking about research with you guys today.
Thank you very much, and thank you very much, Andrea. This has been great. This is a wonderful inaugural lecture for our virtual summer school, and we'll look forward to seeing everybody else, well, everyone really. Tomorrow, Adrian Erlan and I will do a lecture on macro finance across borders, and hope you stay with us for the remainder of the week. And again, thank you so much, Andrea, and thanks to everyone for great questions, and see you tomorrow.
Thanks, Nick. Thanks, everyone.